In this video, similar to problem 527, we're going to look at break even when you're selling more than one product. Let's assume that we sell two different sizes of pizzas, medium and large. The sales price per pizza for medium and large is given. The variable cost per pizza, that will include ingredients like pepperoni, dough, is given. The number of pizzas we typically sell, and then the fixed cost for both medium and large pizzas together is $20,000 per year. Okay, let's prepare a contribution margin income statement. Let's start with the medium pizzas. The medium pizzas sell for $6, so I'll take 6 times. We typically sell 3,000 pizzas. So 6 times 3,000 is 18,000. Variable cost for the medium is $4 a pizza, times 3,000 pizzas is 12,000. And to get the contribution margin, I will subtract the sales of 18,000 minus the variable cost of 12,000, and you get $6,000. Okay, let's do the same for the large. Selling price for the large is $11 a pizza, times we typically sell 6,000 pizzas per year for 66,000. The variable cost is $7 a pizza times 6,000 pizzas is 42,000. Then take 66,000 minus 42,000, and our contribution margin is 24,000. For the total column, we'll just add the medium and large together. So 18 plus 66 is 84. 12 plus 42 is 54. And I can go vertically or horizontally. I'll just go vertically and take 84 minus 54 for $30,000. Next, I will fill in just in the total column, because it's both the medium and large together, that the fixed cost is $20,000. 30,000 minus 20,000 gives me net income of $10,000. Now, I also want to get each of these as a percentage of sales. So in each case, sales will be 100%. So I'll fill in 100%. Now let's start with the medium. Sales are 18,000. So I want to get 12 and 6,000 as a percentage of sales, or as a percentage of that 8,000. Okay, so I will take 12,000 divided by sales of 18,000. Let's convert each one to a percent as we do it. That's 67%. 6,000 divided by sales of 8,000 gives me 33%. Let's do the same for large, but in large, the numbers will be divided by sales of 66,000. So 42,000 divided by 66,000 makes variable cost 64% of sales, and 24,000 divided by 66,000 gives you a contribution margin ratio of 36%. In the total column, we'll use 84,000 as our 100%. So 54,000 divided by 84,000 is 64%. And contribution margin of 30,000 divided by 84,000 is 36%. Now, I highlighted that 36% because we are going to use that in a formula in just a moment. Okay. 1B, it says, what is the break even in sales dollars? Well, we learned one way you can get break even in units is to take fixed costs and divide it by contribution margin per unit. Another way you can get break even in sales dollars is to take the fixed cost, which in this case is 20,000, and divide it by the contribution margin ratio, which I calculated for both pizzas together, highlighted here in yellow, is 36%. So when I do that, I get break even in sales, and I'm going to round to the nearest dollar here, of $55,556. Next, in 1B, we're going to compute the margin of safety in dollars and as a percentage. So let's start with dollars. The actual sales in total is 84,000. So actual sales dollars is 84,000. We just calculated in part 1B that break even in sales dollars is $55,556,000. So if we subtract $28,444 is our margin of safety in dollars. That means sales can go down by as much as $28,444 before we start experiencing a net loss. To get it as a percentage, we'll take my calculation in sales dollars, a margin of safety of $28,444, and divide it by the total sales, which is $84,000. And that gives you 0.34 or 34%. So that means you are 34% above break even. Okay, let's go on to scenario 2A. We currently have medium and large pizzas. And what I did here is I just copied down from our previous calculations. I copied down the information as you saw in part 1 for the medium and large pizzas because it says that's not going to change. But we are going to add a small pizza to the menu. The small pizza is going to sell for $5 and has a variable cost of $4. If we sell 1,000 small pizzas without any additional fixed cost, prepare the contribution format income statement showing dollars and percentage. Okay, so basically I'm going to add on the selling of the small pizzas. Okay, so it would be 1,000 pizzas at $5 is 5,000. The variable cost would be 1,000 pizzas at $4 for 4,000. And you would have additional contribution margin of 1,000. Okay, so now again, the 5,000 would be my 100%. If I take 4,000 divided by 5,000, divided by 5,000. Let's convert that to a percent. That gives me 80%. And 1,000 divided by 5,000 would be 20%. Okay, now I've got a new total going because I got to get 18 plus 66 plus 5, 12 plus 42 plus 4,000, and 6 plus 24 plus 1,000. Now again, the sales of 89,000 will be 100%. I will take 58,000 divided by 89,000, and that will give me 65%. Let's get that converted to a percentage. Okay. And 31,000 divided by 89,000 will give me 35%. Okay, so 35% then is my new overall contribution margin ratio. Okay, so now let's answer the questions. Let's start with 2B. Oh, and we're assuming, I should finish this out, that fixed cost did not change from 20,000, giving us now a net operating income of $11,000. Okay, so we'll use the same formula as in part 1. We'll take the fixed cost of 20,000. We're divided by the new contribution margin ratio, which is a little lower at 35%. So that has raised our break even in sales dollars to $57,143. Okay, we'll do the same thing here as we did in part 1. However, sales are now 89,000. So 89,000 minus our answer in part 2B of 57,143 gives us a margin of safety in dollars of 31,857. And to get the margin of safety as a ratio, we will take the margin of safety in dollars of 31,857 and divide it by sales of 89,000 for 36%. So now I've noted here, why is the break-even in sales dollars in Part 2 higher when the dollar amount of contribution margin is more? Notice that when the contribution margin ratio drops, in other words, for every dollar of sales, the contribution margin goes down from 36 cents to 35 cents. So since there's less in contribution margin, the break-even in sales and in units would be more. Thank you very much.